Welcome to today's webinar, courtesy of the Kentucky Small Business Development Center in Louisville. Discover no-cost, valuable business services to help you thrive, whether starting your entrepreneurial journey or scaling your existing business. We have the resources and expertise to help you succeed. For more information, please visit our website or text 502-977-5800. Thank you for joining us today. Feel free to use the chat feature to ask questions or engage with our speaker. Let's get started.
Hi, welcome everybody. Thanks for joining us today for another Toolkit Tuesday. I appreciate you joining us. And we have a great guest today. And I'm also joined by my good friend and coworker, Janet Flaw. How are you, Janet?
Happy Tuesday to you, Dave.
Yeah. Before we bring in Phil, I just want to make sure that everything is working well and you can see and hear us. So to look at the bottom of your screen, you should see a toolbar. If you don't, just hover your cursor over that and it should pop right up. And if it doesn't, I don't know what to tell you, but it should pop right up. And there you'll see the little chat button. If you just click on the chat and type in your name and where you're joining from, you can see and hear us. Everything's going well. We generally want to make sure that all this works. Just to make sure we get some tech challenges here and there. So I can see everybody popping in and joining. The numbers kind of jumping in. Hey, Katie in Berea. Katie's with the Small Business Development Center. She leads the center down there in Berea. Hey, Jason. Doug. Hey, Doug. Elon. Hey, Larry. How are you today? Good to see you. I saw you yesterday in the coffee shop. Or was that the day before? No, it was yesterday. Hey, Meriwether and Hazard. Good. Sue in Lexington. Got some folks coming around. Hey, Steve, Chicago, you have our distance award today. Hey, Kendall. Kendall's in Indiana. So our numbers are still popping in and people are getting settled in. We've been really kind of thinking about, we've had our guest today, Phil Lyson from Murphy Business Sales several times, and he is a fantastic resource. This kind of little thing that I keep in my mind is that, if you want to sell your business, you should start today, not when you are ready to sell. Every day you should be ready to sell, and by preparing to sell and getting your business ready for an investor or a buyer to look at your business, you're actually putting together a professionally run and easier to manage business. There's a lot of pluses for this. So, Phil, I'd like you to pop in here and introduce yourself, and you're going to help us understand what are those steps we need to take to prep up for our business to sell or not, because every day is kind of a decision day, I would guess.
Yeah, for sure. We'll get into all that today, and I appreciate you having me. And my name's Phil Ellison. For all of you out there who don't know me, I did see some names I recognized, which was kind of cool.
Mm-hmm. Right.
I'm going to go ahead and share my screen if that's okay. If you're ready for me to
Absolutely.
jump.
I'm going to get out of your way because this is a very important topic. Even if you don't want to sell your business, this is super important.
All right, David, are we good? Can we see the screen?
Looks fantastic.
Yeah.
Great. Well, again, thanks for having me. Welcome to Toolkit Tuesday. I want to thank the Louisville Small Business Development Center, and specifically Janet and David, for inviting me to talk about this very important topic. Today's session is about understanding what buyers really look for in a business and how you can position yours to stand out. So as I said, my name's Phil Ellison, and I'm the Director of Corporate Brokerage Services for Murphy Business Sales. We're a franchise group, and we are headquartered in Clearwater, Florida, with 140 plus franchise offices throughout the U.S. and Canada. Our focus, it's on Main Street business brokerage, and lower middle market M&A advisory services. So in addition to the corporate role, I'm also a franchise owner with locations in Louisville, Cincinnati, and Nashville. And yesterday, this is kind of cool, Murphy Business Sales announced that we've now exceeded $4.3 billion in closed transactions. And, I think one of the most impressive parts of that achievement is it was just 2 years ago that we eclipsed the $3 billion mark. So we're over 1.3 billion in the past 2 years of closed transactions. And, we're a company that's over 30 years old, but what this kind of illustrates is the evolution of our advisor group, where we're very selective about who we bring into the network. And as a result, we're becoming a bigger player in the lower middle market transactions in that world. So our average transaction size is about 3 times that of what the typical business brokerage industry transaction is. So, why am I here today? Well, I've been in the business brokerage world and M&A advisory world for a while now, but prior to that, I was a business owner, just like you folks out there. I started a manufacturing distribution business. I acquired and scaled and sold a lower middle market fuel distribution company. So I understand that some of what we're going to talk about today, it can be challenging to implement, but that's why finding competent, experienced professional advisors is very important if you aspire to have a healthy, growing, and sellable business. So goals for this session, I hope that each and every one of you leave here today with a broader knowledge of what you can do today and in the future to better position your business for sale. This session is applicable to anyone who is a business owner or works with business owners. That could be advisors that are in any facet of the exit planning world, or even those who are not owners, but maybe running the day-to-day management and are the operators of those businesses. So I like to approach this from understanding the buyer's mindset. What is important to a buyer is going to be reflected in the value of your business at the end of the day. So there's different types of buyers out there. You have strategic, financial, and individuals. Strategic buyers are those who want to find synergies in their acquisitions. So think of a business in, say, a neighboring state or region who would like to expand with a presence in a neighboring market, or maybe it could mean acquiring a company that makes or distributes a product that is used by the same consumer who purchases the products that your business makes or distributes. And then you have financial buyers. So that would be an example would be a private equity firm who really what they're looking for are returns. And in these types of acquisitions, an established management team is very important because these buyers are not operators. You as the owner may be expected to continue in some role for an extended period. But the advantages could be really great for you selling to this type of acquirer, because if you don't sell 100% of the company, or you sell 100% and roll equity into the new company, if there's growth under that new company ownership, there could be a second bite of the apple, meaning a second liquidity event that is hopefully at a higher valuation as a result of the growth under this new ownership of private equity. And then we also have individual buyers who are often operators themselves. That's what I was. I was just a person wanting to buy a business and run that business. And so that's what I did. And each of these different buyers views value differently, but they all want ROI, and they all want low risk, and they all want growth potential. They're asking questions when they look at your business like, can it run without you? Is the business scalable? And what are the potential hiccups we might face as a buyer of this business? It even goes beyond, they may want to ask themselves, does the owner hold personal relationships with customers and suppliers? That can be a big hurdle in the sale of a business. If that owner is personal friends and hangs out with all of their customers, it's going to be hard to transfer that relationship. So now I want to talk about the core drivers of business value. The buyers, they focus on several different value drivers. This is a list of, really the most important ones, I think. Financial performance and clean books are very critical. If your books aren't organized, you're not making money, it's going to be very challenging to sell that business. Growth potential, that adds premium. It may not inflate the value of the business tremendously, but it makes it very valuable in the eyes of a buyer because they know that when they acquire that business, there's going to be some upside. So it can add a premium, although not tremendous amount, as I said. Then there are some of these value drivers that, can add risk to the equation. So a high customer concentration is very risky, and we're going to dive deeper into that subject in a minute because it can create some real issues if you're trying to sell your business. Recurring revenue, strong teams, and competitive advantages in your business all are going to increase the attractiveness of your business to the buyers. So I want to talk about red flags. There's some common red flags out there. It would include over-reliance on the owner, messy or inconsistent financials. Pending litigation could be another. If your company's tied up in a lawsuit, it's probably not the time to sell. You need to get that resolved. Some other things that I've seen in the past, rather, environmental issues. So if your property has an environmental issue and you haven't had a phase 1, maybe that's something you want to explore to try to figure out what the risk is there, and then maybe go ahead and take care of those issues. Revenue instability, another issue. So we see some businesses where revenues up and down year over year. That can make it very challenging when you're trying to sell your business because a buyer doesn't really know what to expect year in and year out. And so it makes it challenging to come up with a purchase price because they're gonna move to the lower end of value to make sure that they're covered should you end up on the low end of that cycle. So that's an important thing to think about as well. So if you're looking at a chart and your revenue and earnings are going up and to the right, that's great. If they're going down and to the right, that's going to present a challenge. We want to see revenue trends that are increasing year over year in an ideal selling situation. Unfortunately, buyers are not in the market to buy a problem. And so that doesn't mean that a buyer may not see opportunities within your company, but they don't necessarily pay for the work that they are going to have to do once they step into that role as the owner of the business. They're paying a price based on the performance of your business. Another thing that I did not mention here that I want to point out, vendor instability. So, if you have one supplier, that poses a risk potentially to buyers. What if that supplier went out of business? You can imagine the issues that it may create for your business. So I think having a sense of what other opportunities are out there among your supply base so that you could potentially pivot. Now, if you're bringing in product from overseas, you may not have a lot of options. You may be working with one manufacturer, but it would be in your best interest to explore other backup plans. That's gonna help mitigate those risks long term. So I mentioned I was going to get into customer concentration, and this chart kind of shows you rules of thumb in small business. Um, if your largest customer, that single customer, is greater than 20% of the total revenue of your business, that's considered very risky. Um, and strong dependency on that one customer, it is going to create issues with your valuation. Ideally, we like to see under 10% for your largest customer. Um, Obviously, less is better. But this chart just gives you an idea kind of what these breakdowns are. And when we're looking at these opportunities, when you get into that high risk, even when you get into elevated risk to some degree, you're going to find that in more times than not, it's either going to be a flat out deal breaker, or you're going to be subject to earnouts or holdbacks. So an earnout may be dependent on earnings or revenue. It can be tied to gross margin as well, gross profit as well. Holdbacks, those could be in the form of, say, a forgivable seller note. So um, you may only get your money 1 year if you reach these certain milestones. If you don't reach them, you have to forgive that year of your seller note. So that is to protect the cash flow of the business in the event that you have these high risk scenarios of high customer concentration. And why is it a problem? Well, it all comes back to the risk of the reduction in cash flow. Lenders are looking for exposure to risk and asking if the business can cash flow the debt if this large customer goes away. So I mentioned seller financing. Seller financing is something that I'm often told by sellers is a deal breaker. But the reality is seller financing is very common in small business transactions, especially if there's an SBA loan in place. Now, it's usually around 10% of the total purchase price if it's a cash flowing deal. But the purpose of it serves as a de facto insurance policy to ensure a smooth transition from one owner to the next. And more importantly, it ensures some cooperation from that seller. Um, so if you buy a business and, 2 years from now, some question comes up that, hasn't presented itself to you in the past and you're not sure how to handle it, if you have a seller note with that owner and you just pick up the phone and say, hey, can you help me with this? They're a lot more willing to answer if you are still paying them out. And so, although it's a small amount of money, it's still real cash, and it's incentive for an owner to make sure that transition is smooth. Um, I mean, if your plan is to sell the business and then just walk, there's a good chance you're not going to sell. Some owner involvement and training post closing, it's always going to be expected. So just be prepared for that. And what I like to tell people when we're approaching a potential sale is think of it in terms of you almost have a 2 year run out. And what I mean by that is, on average, it takes us 9 months to sell a business. And that's preparation all the way to closing. Industry average is 12 months. So I, err to the side of caution, I go with the industry average. And a buyer may want you involved in the business for up to 12 months. The SBA has some rules out there where, the owner isn't supposed to work in the business longer than 1 year. So assuming it takes 12 months to sell and assuming you need a 12-month commitment to the new buyer, new owner of the company, now you'll get paid for that. That's 2 years. So when we go into these engagements with business owners, that's how we try to prepare them. And if we can do better, then that's great. So it's all about setting expectations. So some solutions to this issue that, again, this is a very common issue among small businesses, but it may be easier said than done, but diversify your customer base before going to market. So start planning and thinking through strategies for doing that. But if it's not possible, some ways that you can mitigate the issue, long-term contracts with customers. If you have contracts and you can get assign them to be assignable, that's good, because if someone acquires your business, it's an asset purchase. You want to be able to assign that contract to the new ownership group. So that's something to think about. Talk to your attorneys about if they're drawing up these contracts for you. Being able to show that you have strong relationships that go beyond you as the owner, and then backup plans for pipeline growth. Start working on some other options that are going to diversify your customer base and bring more people into the fold. It's really important if you can prove to a buyer, to the market, that this customer of yours is tied to your specific process or product, and not just you because you go fishing with them or you play golf together on the weekends. So how do you position your business to stand out? You know, it's important in the market to differentiate yourself. To stand out, you need to professionalize the operations by investing in your team. This might present some short-term pain, the expense of it, but I've seen teams enhanced that, end up resulting in growth trajectory for their business. So, this is not if you want to sell in 6 months, start doing this. These things take time. Ideally you're planning three years in advance from a sale. I mean, you could get it done with a lot shorter timeline, but these things do take time. So again, it may present some short-term pain, but I think that the long-term benefit you will realize if you manage your team successfully. So you need to document systems and processes. If everything is in your head, all the processes, how everything is done in your business is just in your head and it's not documented anywhere, I would encourage you to start that process as soon as possible. I would also highly recommend that you normalize your financials by removing, personal expenses, one-time expenditures. And we're going to take a deeper dive into that here in just a moment. It's really important that you show the true cash flow of the business, and we're not settling for a bunch of add backs to make the numbers look good. So if you have one vendor, I mentioned the vendor issue, talking about that a little bit more, something else to think about is if you lose that one vendor that you're doing business with, you may be able to find another vendor who can replace them, but will you have that same pricing power? And if you don't, what does that do to your margins? Do you have room to raise the price? Another issue that, maybe you can get the same price, but can you get the same payment terms? You may get 45 days from your longtime supplier, but if you have to switch and you have to pay in 30 days, that has an effect on the cash flow of the business. So that's just something to think about and why it's worth, exploring some other options when it comes to vendors. If you're solely, putting your eggs in the basket of one. And then very importantly, create a clear and compelling growth story that buyers can believe in. So, a lot of times when I'm working with clients, if I go into them and I say, hey, what would the first two things you would do to grow your business today if money wasn't an object? And if they don't have an answer, I think that's somewhat of an issue, because you need to be able to paint a picture for a buyer that there are some things that that they can come in and do that's going to help grow the business and grow it long term. So, let's face it though, whenever we as owners have been in the business a long time, we may get We may get burned out, we may get bored, we may get complacent, but if that's happened and you're not on a growth trajectory, I would highly encourage you to start thinking of and strategizing of ways to grow your business and implement a strategy there. So, and then the last thing is really presentation. And this falls back on hiring a good advisor to assist you with the sale. Presentation materials are extremely important in the sale process. Some other things that oftentimes people don't think about is, being coached on how to handle these buyer meetings. There's things that you should disclose, and there's things that really don't need to be discussed. Not material, but if you're feeling negative about your employees, we really don't need to be talking about that in a buyer meeting. You need to be promoting the skills of your team, not how frustrating it is to be their manager. Having the information readily available that a buyer will want to see is also really critical. So what I mean by that would be sales reports, and we coach our clients on that. We provide them with a enhanced due diligence list on the front end, so that you can see the types of things that a buyer's going to want to see, and we'll try to populate a data room ahead of time. But these can all be enhanced if you work with a professional advisor, whether it's me or anyone else. They can help you with these. So now I want to take the financial deep dive that I talked about. You really, as the owner of your business, you should really know your numbers. You really should have a good understanding of the financial performance of your business, and you should have reports readily available to help you with reviewing that information. So, if you can't tell me your revenue or net income, or if you need weeks or months to generate those reports, your financial reporting is probably not where it needs to be. And if you're the type of owner who is only tracking your bank account levels to judge performance, then your books aren't organized, and probably the best move is to outsource those responsibilities to a professional bookkeeper or a CPA, or maybe even hire a fractional CFO. But it's extremely important that you get that part of your business, this part of your business organized. People always reference personal um, expenses in their business, and they reference it as add backs, which is part of this business. When we're creating the cash flow models, we do add back personal and one-time expenses. Um, but one thing to think about, oftentimes people come to me and say, hey, here's our add backs, and we take this much distribution. Distributions are not on the income statement, so they're not an add back. The only thing that is an add back are personal expenses, one-time, non-recurring expenses that are on your income statement. Um, and I think there is a myth out there that underreporting your earnings is going to actually save you money. I would argue that it actually costs you money. So, especially if you plan to sell in the next 3 years. If it's 4 or 5 years out, I guess it probably doesn't matter as much. But um, the example is, for every dollar that you don't put on your tax return, let's just assume that you're saving 35 cents each year. So over 3 years, that's $1.05 that you've saved by not reporting that dollar in your net income. But what if you did report that dollar? So if you did report that dollar and you got a very modest 2.5 times multiple on your earnings, you would actually receive $2.50 for that dollar when you sold. So you receive $2.50 versus saving $1.05. The net is $1.45 pre-tax. What if that's $100,000 that you didn't report? It's 145,000 in that example. So it adds up quick. Um, you know, saving taxes versus, gaining dollars on a multiple of earnings, the math works out in your favor to just go ahead and keep the personal expenses out of the business, run it clean, and take that multiple of earnings down the road. If you do have adjustments, keep well-documented records. Because if you do want a lender to give you credit, you need to be able to prove it. The bank has the money. They're always the third party to the deal. I always tell people, there's the buyer and there's the seller. But if the bank doesn't agree, we're probably not going to close. And so, frankly, the bank doesn't want to see you double dip if you're cheating on your taxes and then attempt to get credit on it when you try to calculate your sales price. But legitimate discretionary expenses are okay, just not blatant tax cheating. So the next subject, make sure that your tax returns and financial statements match and tie out to your bank statements. So if it's not, run your report. So if you do your tax returns or cash basis or accrual basis, whichever one, run an income statement. If it's cash, your income statement is cash. If your taxes are accrual, run it as accrual. And make sure that those numbers match up. If they don't match up, there's something going on that needs to be fixed. This is where you might need to bring in a, bookkeeper, CPA, someone to fix this issue. It can be a big issue if these don't get fixed, because it just goes on and on year after year after year. And the bank statements for due diligence purposes, when people are performing their due diligence, they're going to refer to bank statements and make sure that the revenue coming in matches the revenue in those bank statements. Another thing, have the ability to run key sales reports out of your system. And if you're not set up to run that way, meaning you don't have your sales broken down into certain categories, you may want to work with your bookkeeper to start doing that. That way people can see trends by product, service, whatever it may be. And these become important, especially if, for instance, you're a company that does some commercial and some residential sales. You may be talking a buyer that covets the commercial versus the residential or vice versa. And if you can't show the difference, they may not pursue that opportunity if they can't easily designate between the two. So why does it matter? Well, clean books, they build trust with buyers and lenders, reduce time and friction during due diligence, and they justify our higher valuation and minimize the chance of a deal retrade or renegotiation. And, unfortunately, retrading and renegotiations, they happen. It's never a good scenario when they do happen. There's always people who are upset in that occurrence when we have to deal with it. But at the end of the day, you can help mitigate that issue by having clean books and records and having really good reporting that you're able to access. So I want to talk about, steps that you can take today to start preparing yourself, for exploring an exit, whether it's now or down the road. David mentioned it, and, you should be planning as early as possible. You should start with the end in mind. I think that's a Dale Carnegie saying, maybe. But when you buy a business, well, I'll use my own example. When I bought the oil company, my approach to buying that business was, what does my exit look like? And so, I thought about growth opportunities and, the market and what it might look like down the road. So, some things you can do now is you can conduct a mock due diligence. So, you could do what I just mentioned, look at your tax returns, look at your income statement. Do they match up? You could have someone, whether it's a business coach or CPA or bookkeeper, assist you with this. A benchmark valuation is another good starting point. So I do those. There's plenty of other people out there who do valuations. Get a valuation and find out what your business is worth today. You may have an idea in your mind and it may not match with the reality of the market. So if you benchmark the value of your company now, you'll know some things that maybe you need to do in the future to get to where you need to be. Or maybe you are where you want to be now, and that's a great thing. And maybe that means talking to your financial advisor, you're in a position where, you have everything you need. Now you're just risking it by continuing in business. So maybe a sale is the right option. But get that benchmark so that you know where you stand today. And fix the red flags while, now, you have time. So do it now and don't wait just until you're ready to sell. Buyers are really going to see the difference. Um, you know, Work with someone to identify issues in the business that could make or break a deal. And again, start building that exit plan as early as possible. These are really more because I can't really get into specifics of deals, but these are just kind of examples of, and they're very simple, but like things that can help or hurt evaluation. So, business A, they had great earnings, uh, but really relied on, one client. Um, I think it was in this example I looked at, it was like 50% of their business. So the valuation took a big hit. I mean, I think it was more like a 2x, two times their earnings is what they got in an industry where it should have been every bit of 3x. So their valuation took a hit. But, the buyer had to account for the possibility if they lost their biggest customer, now they would be half of the size of what they were. So 2x in that case might actually be a good deal. In this second example, I had a company that I worked with. The owner was so organized. I mean, his systems and processes were just documented to a T. Everyone knew exactly what they were doing. Recurring contracts with customers. Um, I think the earnings maybe weren't as good as they could have been, but at the end of the day, he got what, in my opinion, was a premium multiple because it was something that someone could step into and they could really rely on those results year in and year out because of what he had put in place as an operating system and contracts with these customers that were just going to repeat year over year. And then in example C, you have a company, this particular deal was a larger transaction. And so they had a management team in place. You can't always have the luxury of having a management team in place. It's expensive, I get it. But a larger transaction, if you have a management team in place that can run the day-to-day, you can attract strategic buyers who would be willing to pay a premium. In this particular case, that's what we found. We found someone that was willing to pay 6x and they paid cash. And it doesn't get much better than that. But they had a sales force, they had warehouse managers, they had operations managers, they had IT person, they had everything there that the new buyer would need to step in when that owner exited the transition phase, which was going to be about a 6 month. They had everything they needed right there, so they could pay it. They were already in the industry, so it made it a lot easier as well. So I wanted to, before we wrap up, in these next few slides, I wanted to share a really interesting fact. And the source there's a couple sources, but IBBA, which is International Business Brokers Association, and EPI, which is Exit Planning Institute, both of which I'm part of. Um, you know, this is for small businesses. So we don't really get into middle market with these stats, but a small business could be up to, I mean, depending on who's defining it, it could be up to 10 million in revenue, but only 20 to 30% of small businesses that go to market end up selling. I mean, to me, that is an astonishing and honestly scary figure uh, to stare down. So that means 70 to 80% they don't sell. And it always circles back to what I talked about, poor preparation, could be unrealistic pricing, or, just weak and unorganized financials. And I would say when I talk to someone who's thinking of selling their business, I don't know the exact figure because I haven't tracked it, but I know it's at least half of the people I've talked to always have a story about, well, we had a buyer, or, we were talking to someone and we thought we had it sold and it fell through. And there's all these different cases of this happening. And a lot of times it's individuals that just directly approach a buyer or a seller about selling their business. And, you know, neither party in the transaction really knows kind of the process and the steps to take to get it to the next point. And at some point along the way, every deal, there's some type of speed bump, and you got to figure out a way around it. Probably should say roadblock, because it seems like, 3 or 4 times a transaction, it's a make or break moment. And you got to have someone, whether it's a broker or, an M&A attorney, someone who has been through the process before and knows what the workaround is, or know what the solutions are, that can present to you as the seller or the buyer what those answers are to get around this issue. So it really helps to have, and I'll talk about this next, it really helps to have uh, professional representation. So these are also, why so many don't sell. I mean, this is the reason. And this is again sourced from the IBBA, and Exit Planning Institute. But, overpriced. I mean, think about it. If the math doesn't work, the business won't sell. So our process, we get deals pre-qualified by an SBA lender. So did that 6X deal that I mentioned, would that have been able to be qualified by an SBA lender? No. But it was a different market. We were going after strategic buyers. If it is a small business and it's valued under $5 million, it's probably an SBA transaction. 5 million is the SBA limit. So it's got to be priced right. And so we go out and we get lender pre-qualification letters, SBA pre-qualification letters. I keep saying the wrong word. And so what that does is that justifies the purchase price, and it also improves the speed of the transaction, because now you have a lender who's familiar with the deal. We've touched on the poor and inaccurate financials, owner being too central to the operations. Again, the more you remove yourself from the business as the owner, if you can leave town for a month or leave the country for a month, and that business can run just as well without you present as it did with you present, you have a good business. You have a very valuable business. We've beat customer concentration to death, but there it is again. And, your business really needs to be on the incline, not the decline. It could be poor market demand in that niche. And that's where you talk to an advisor who can tell you that's the case, and it's not the time to go to market. And then again, lack of professional representation is really a key reason why most of these sales don't happen. So I'm just going to leave you with these last two slides as a reminder of what you can start doing today. Pretty much everything we've talked about, but I feel like, you can't be too repetitive when it comes to some of these topics. But this is a nice little order that you can go in, prepare 1 to 2 years in advance. I prefer 3 to 5, but I also think you should always be preparing. If you build a company that's sellable, runs itself well, even if you don't sell the business, you have a nice situation where you have this great business that's running well, maybe even without you, on a semi-absentee basis, in a great scenario. So get prepared, work with an advisor or broker to start planning and understanding what the value of that business is and what you need to do to start getting it more prepared for a future sale. Clean up all your books and systems. So if you have to bring in a bookkeeper or CPA, do that. If you need to work with a business coach to start documented systems, call Small Business Development Council. Talk to those guys at the center and get their help. Get these things documented. Don't keep all the processes in your head. Reduce the owner dependence. That will occur when you clean up your systems and processes. If you have strong employees who are fully capable of customer service or relationship building, allow them to do that. You know, enable your employees to make decisions for themselves and to take their own ownership in the business. Whether that means you give them some type of a profit sharing, I don't know what that looks like for each of you, but whatever you can do to make those employees act like owners is going to help you in the long term and reduce the dependence on you as the sole responsible party of that business. And then set realistic expectations on value. This is where I mentioned, get a benchmark valuation, know where the market is, understand the true potential of it, and set your expectations accordingly. And sometimes that might mean that a sale to a third party isn't the right move. Maybe there's an employee in your company that you could transition the business to. My job as a broker is to provide you as the seller with an option. So I'm presenting you the option of what it looks like to work with me, but there may be other options out there that are a better fit for you, and you should explore all of those. So the key takeaways, buyers are paying for future earnings and reduced risk. So the easiest way that a buyer can determine future earnings is by your most recent performance. So we want to see performance that is strong and growing over a period of time. Focus on transferability, growth, and risk. The easier business is to run and grow without you, the more valuable it becomes. And start preparing now so that you can maximize value later and prepare for that smooth. Hopefully it's a smooth sale, but I will say they all have their challenges. Nothing is easy. And that is it today. I'd love to hear some questions or comments. If you have any feedback today, I'd love to hear that as well. If you want to send me an email and let me know your thoughts, or if you had any ideas of things I could have mentioned that I forgot to mention. There's a never-ending list of issues when it comes to selling your business, preparing your business for sale. But when you leave here today, I would encourage you to go back and reflect on your business, its strengths, its weaknesses, and try to drill down on those and figure out the best path forward for yourself.
Mhm.
So, David, thank you.
Yeah, that was great, Phil. I do have some questions.
Yeah.
And this is kind of a good one. So let's just say that you make the decision that you want to talk about moving your business, selling your business, and you've kind of gone through all the de-risking steps, and you feel like it's time to talk to somebody. What happens next? I mean,
Yeah.
do you talk to a bunch of brokers? What do you do? What's the best thing to do?
Yeah, I mean, my opinion is you should find the person that's the right fit for you. Now whether that comes directly from a referral and you feel comfortable with, talking to one person, or if it's reaching out and contacting, multiple brokers, I think at the end of the day, you need to find the right fit. And like, I don't take every deal, so I might not be the right fit. It might be my decision. It might be your decision.
Yeah.
But I find that, if you have people that you trust and know, that you're already working with in some capacity, that there's typically, you're going to get some good referrals from going to those people and asking them their opinion on who you should work with.
Okay. Well, let me ask you this. So let's just say you agree to work with me. I mean, how do you market a business? How do you generate a buyer for somebody?
So everything is done confidentially with us. So we have several channels that we kind of go down. I have probably 10 people a day that want to buy a business that contact me. And, I try to filter through those, qualify those buyers, create a database that I have of buyers. Local buyers, especially, I stay in touch with. Most of your buyers are local. Unless you have a business that's, you know, really large, that's going to attract a strategic buyer. So I stay in touch and I have those folks that I work with. And then this is just us at Murphy Business Sales. We have 240 advisors around the country. So we all have exposure to each other's deals. We all have worked with people in different industries. There's another kind of channel we can go down. And then we'll create target lists. So if you're in HVAC and you know, tell me that you want to sell and you would like to sell to a strategic buyer, we'll make a list. And maybe there may be some PE buyers in there too. And then the fourth way that we go to market is we do post to third-party websites. So Biz Buy Sells of the World, Axial. However, because it's confidential, regardless of who we're talking to, everyone must first sign a non-disclosure agreement.
Mhm.
We ask some questions on there that kind of, we want to know how much cash someone has available for down payment. We want to know their net worth. We're trying to qualify them. So before they ever find out the name of that business, I'm going to have a phone call with that person and I'm going to find out what is their skill set and experience. Does it fit this business that we're selling? Because as you know, I mean, an SBA lender may not lend if you know,
Mhm.
have been running a restaurant and now you want to run a manufacturing business. They may not see that skill set fit. And then financially, I'm doing my best to qualify. And then, from there, if we feel like they're a quality buyer, a legitimate buyer, then we'll disclose and share the SIM with them.
Okay. Great question. Jason has a good question too, just on a clarification. When you say 2.55x multiple, is that based on revenue or net income, or what's that based on? What are you talking about?
That particular example, seller discretionary earnings, is what I would say that would apply to in that case. And that was just 2.5x was just, an example. Um, it could be less, it could be more. But if you don't know if anyone out there doesn't know how to calculate their seller discretionary earnings, they can feel free to reach out to me or David. I'm sure you could probably do that as well. And we can go through
Mhm.
that, that process and help you get that number so you can better understand what it is.
Okay, good. Thank you. Doug asks, I'm not sure exactly here, but how do the C caps change from industry to industry?
I'm not sure what was that? The C cap.
Yeah,
Okay.
I'm not sure either. Doug, maybe you can pop in and let us know what you're asking for. Um, let's see, Kendall says, what if you want to sell a building you own that you're operating your business and not the business itself? Are you better going through a realtor or a service such as yours, Phil?
So okay, so they want to keep the business and sell the property. So,
Yeah,
okay.
yeah.
Yeah. So
Lease back, I guess is what that would be.
yeah, sale lease back. Look, I have my real estate license and I sell properties with the businesses, but if you came to me, I would refer you to someone that does sale lease backs. So
Mhm.
there are people who specifically, they specialize in that. That's what they do. Now we have some firms we've worked with nationally that'll do that, but commercial real estate for sure.
Okay. Doug says the multiples. How do the multiples change from industry to industry?
So they can, yeah, and they'll change within the industry depending on the size of the business as well. And so I've got 4 databases that I subscribe to where I've got data, comparable data. And so when we run it, we'll pull a data set and we typically take the industry and we take the revenue of the target and the earnings of the target, and we'll do a plus minus percentage of that revenue and earnings, and we'll get a data set that hopefully is reflective of that particular target business. And we'll do we'll do an average and we'll do a min max review, but it will change, and sometimes it changes from year to year, just depending on what's hot, what's not. So
Um, what would you tell the folks there? What resources should they access? Or let's say you want to start learning the process,
Yeah.
where would you start? Where's a good place to go?
Yeah, I mean, obviously you can have a direct conversation with a broker, an advisor. Um, there's a ton of information out there, whether it's on my website or it's on just, IBBA, which is International Business Broker Association, M&A Source, which is mergers and acquisitions um, group that I'm also a part of. There's a lot of different, resources out there where you can find information about the process. If you went to my website and you could fill out a form and we could send you, I mean, I have, the 9 steps to selling your business, 10 pager that I could send. And there's
Mhm.
several of those pieces of information out there.
Okay. All right. Well, looks like about all the questions we have, Phil. This has been really, really enlightening. I really appreciate you spending your Tuesday with us today and sharing with
Yeah,
everyone. With the amount of questions we had, I know everyone got a great amount of value out of your our time today. So thank you so much.
good. Well, I always enjoy it. This is, I think, my 3rd time with you all, and
Yeah.
yeah, happy to do it again down the road. So thanks again.
We'll be calling you.
And it's nice too, because after the last one, I had several people reach out and they just had questions, and
Mhm.
always happy to answer those questions for people.
Yeah. So, well, thanks again. Janet, thanks for joining in and driving the ship for us as always.
Sure thing. Thanks so much, Phil.
Thank
Thank you. Talk to you all soon.
Yeah. And do we have a survey, Janet? Yeah, everybody just kind of hangs on for a
Yes, we
sec. We do have a survey. Usually Janet's the one who reminds me to say that, but I got to say it this time, so. Yeah, so, well, thanks for joining everybody, and don't forget to take the survey. It'll pop up in just a second here, so hang on and do that for us. It really helps us out, helps us improve things, and gets you the information that you want us to bring to you, so. Thank you, Phil. Thank you,
Thanks.
Janet.
Yep. Take care.
We'll see you guys next week. Thank you.